Hey friends, this is Harshit here. So in today's video friends, I am going to talk with you about why always the monetary policy of RBI is not as effective as it should be. Okay, now what is monetary policy of India? In the monetary policy of India, through the policy rate, through the repo rate, what the RBI does, RBI actually, what is repo rate? Repo rate is basically that rate at which RBI lends short-term loans to the scheduled commercial banks and to other clients. They may be the central government and state governments also. Okay, this is repo rate and this is also called the policy rate. Mind it friends, repo rate is different from the bank rate. What is bank rate? Bank rate is that rate at which RBI lends to banks on a long-term basis without the requirement of a collateral. But in the repo rate, in the policy rate, the collateral is required, and in most of the cases that collateral is government securities. So basically, for controlling inflation, for stabilizing the economy, RBI resorts to policy rate. Now, why the monetary policy that is changing the rates in India is not as effective as it should be or as it is in the USA? Now, the problem with India's monetary policy is that the first problem, in India, the financial inclusion is not very high. Okay, many people don't know about financial tools. You must be, in the advertisements on channel, you see that mutual funds ad is coming, that invest in mutual funds, you will get this much money and that much money. And there is a lot of, emphasis going on right now on using mutual funds and other financial inclusive alternatives. This is a campaign which is initiated itself by the government. Why is this happening? Because in India, the problem is that people don't have too much of financial knowledge. So whatever their money earned, they deposit it in the bank, but they don't invest it in things like mutual funds, stock markets, derivatives. In these type of things, people are not investing. So obviously, the amount that people are earning, they are depositing it bank, but they are not investing it in the market. Either they are purchasing gold or they are purchasing real estate, and if they are not purchasing gold or real estate, they are depositing it in the bank. So banks have a lot of deposits. Okay friends, so obviously what happens here is that when RBI changes its repo rate, okay, now by repo rate RBI is lending money to the banks, but if the banks are already having deposits of the depositors, why are scheduled commercial banks going to take money from the RBI? As sample, when we compare this situation to the United States of America, what happens in the USA? In USA, the Federal Reserve lends the money after the subprime crisis, the mortgage crisis after 2008. What the Federal Reserve did? Federal Reserve slashed its lending rate, that is its policy rate, to 0%. So it was literally giving away money at 0%. Now the policy rate changes of United States of America are much more effective when we compare it to the RBI in India. Why it is much more effective? Because the financial inclusion in USA is very high. The financial literacy of people in USA is very high. So what happens in that case, that people in USA know about financial products, they know about mutual funds, they know about stocks, and they invest in it. So obviously they are not going to keep their deposits idle in a bank, they are going to invest it. So obviously banks in United States of America are not having a lot of deposits of people. So from where the banks in America are getting money? They are getting money from the Federal Reserve. So obviously any change in the policy rates by United States of America is going to be seen in the economy pretty soon. But in India it is not going to be as such, because RBI's RBI repo rate is that money through which RBI lends to the banks, but banks are using the deposits of depositors to lend. They are not using that amount which are coming from RBI. They are using the amount which is coming from RBI through the policy rate, that is repo rate. But actually I am using sometimes policy rate, sometimes repo rate. Policy rate and repo rate are the same thing. Okay, so don't get confused in it. So obviously, banks in India are using the deposits of people for lending, and obviously in some shortfall cases they are taking money from RBI. So obviously the requirement of scheduled commercial banks of money from the RBI in India is not as acute as it is in the USA. So this is the very first reason that why monetary policy changes by the RBI are not so instantly effective. The second changes is global price fluctuations. For example, the crude oil prices, it may come down it may come upward. So a lot of things depends upon the crude oil. Okay, weather changes affect a lot. For example, El Nino comes, El Nino southern oscillation comes, Indian dipole comes. So if in the Indian dipole, for example, the eastern Indian Ocean is getting warmer and the western Indian Ocean is getting cooler, so obviously the force by which the monsoon through the southeast trade winds is entering India will weaken down, and the rainfall and the monsoon patterns will be affected, and consequently the agriculture will be affected. So obviously weather patterns are also having an effect, and RBI has actually no control over it. RBI has actually no control over the international markets. This is very much the Fed Reserve thing that I have already told you, that people are not investing in mutual funds too much in India. So these are some reasons that why the repo rate, that is the policy changes by RBI, are not instantly effective in India. And here I will say, friends, that there are some more factors, because there is a a lot of corruption in the economy. If the corruption is there in the economy, so obviously what will happen? Money is flowing out of the formal financial system. Let us see in this thing what happens in the villages. In villages, even nowadays around 40% of the people are not borrowing from formal financial channels. They are till now borrowing from these shroff money lenders, which charge very high interest rates. And from where these shroffs money lenders bring their money? They bring the money by corruption. It is the corrupt money of politicians, bureaucrats, which is being circulated illegally among the people, among the the poor rural masses. So this is also a big problem. So a parallel corrupt economy is a economy of black money is existing in India. So that is also hurting our chances of a good economy. And in this thing, friends, these are 3 or 4 points. One more point important is that why the repo rate is not effective. The repo rate changes of RBI, the monetary policy of RBI is very much affected, that because RBI has no control over the supply side economy in India. The supply side economy, for example, what RBI can control? RBI can control the demand supply by controlling the amount of money in the economy, by sucking out the liquidity from the system or putting in the liquidity in the system. But production of things, efficiency in production of things, manufacturing, these things cannot be controlled by RBI. They are outside the jurisdiction of RBI. And obviously because RBI doesn't have control over the supply side economy, so obviously inflation is going to increase if there is changes in the supply side of the economy. Okay, for example, if the supply of a particular product is very less and the money chasing it is very high, so obviously the price of that particular commodity is to go up. Okay, so RBI can control the flow of money, but RBI cannot control the supply side economy. So this is one more reason for why the monetary policy is not as effective in India. So I feel, friends, these points are very much useful. It can be useful for you in the exams. It can be useful for your general understanding. I hope you like this lecture. If you have liked it, please comment and like the video, subscribe to the channel. Thank you for watching it. Have a nice day.